Maryland Center for Collegiate Financial Wellness, also known as MCFU, was founded in 2021 with a vision to help all college and career school students in the state of Maryland achieve these 6 pillars of collegiate financial wellness. That's being creditworthy, ready, resilient, empowered, successful, and thriving. We are on a mission to help students and their families build their financial life skills and empowering them to thrive. If this sounds like a mission you'd like to support, please do visit us online at mccfw.org. And about office hours. Office hours is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. Before I get into the question and answer part of office hours, I just wanted to share with you a quick disclaimer, and that's that office hours is presented for informational purposes only. It should not be construed as personalized financial or legal advice. We provide the most up-to-date, accurate information that we can find, but before you make any decisions about your student loans and your repayment journey, you have to have a good grasp on all the loans you have. You also want to take into account your personal and household financial circumstances before you make any decisions. And you're responsible for those decisions. We just hope that you will use office hours as a supplement to the information that you get from other sources and that personal inventory to make the most informed decision for you and your household. So let's jump right into the questions. We're starting off with a very popular subject this evening, and that is public service loan forgiveness. The question is, I'm applying for PSLF. My servicer said retroactively waiving an in-school deferment would put the loans into a delinquent status unless I can prove I was making payments. Does that sound right? So this is a loaded question. I want to give some background first before getting to some questions that I think this borrower should answer before they go down this road. So a bit about in-school deferments. When a loan is in an in-school deferment, payments are not required because a person is enrolled in school at least half time during an academic term. And because the loans are not technically in repayment, because payments are not required while a person is in school, the payments or months during that in-school deferment do not count toward forgiveness credit for income-driven repayment or for public service loan forgiveness. But a few people that I know have been through the process of at least exploring retroactively waiving periods of in-school deferment. And some people can't believe that this is a possibility, but servicers can retroactively change a loan's repayment status. But if you were in an in-school deferment for, let's say, 2 years, being in a status where you haven't made any payments for that long could cause the loan to go into a retroactive state of delinquency or default, especially for those lengthy periods that go beyond 9 months. So if you have reached out to your servicer and you've asked them about retroactively waiving that in-school deferment period, the response that you're met with might be, you know what, we can't do this because it would change the loan status to being delinquent or default. Or some of them might say you have to prove that you made payments during those periods so that the loans are not placed into delinquency or default retroactively. This is not something that is common, that people make this request, or as far as I know, that the servicers actually grant these requests, but it is a possibility. And the issue with having a delinquency or default come up on your student loan record would be that that's adverse, and that information could be reported to credit bureaus and cause your credit score to decline or cause you to not be able to get access to the best lending terms because now you have a delinquency or a default on your credit report. So when it comes to whether you want to pursue this issue, ultimately your servicer will let you know if this is a possibility, but there are a few things that you need to consider, and timing is one of them. So the first question I would ask this particular borrower is, when was the deferment? If the deferment was after March of 2020, then delinquency would not matter because loans were in the CARES Act forbearance where no payments are required, and the time during that forbearance can count toward cancellation under IDR as well as public service loan forgiveness if the borrower provides proof of their qualifying employment. And we know that this borrower is pursuing public service loan forgiveness. Also, if this waiving of the in-school deferment status is allowed to go forward and the activity was more than 7 years ago, then that might not be reported to the credit bureaus because of the length of time that has passed. I personally do not know if the servicer will allow you to do this, but the fact that they have mentioned it, lets you know that it is a possibility. The other thing that I would ask you is how long was the in-school deferment? Because technically, to be delinquent on a student loan means that you have missed a payment, you're late. So delinquency is something that happens right after you miss a payment. It doesn't take a long time to become delinquent. Default, on the other hand, happens after you've missed payments for at least 270 days. So we're talking about 9 months of no payments before being put into that defaulted status. If you know that your in-school deferment was less than the 9 months, then you would not go into default. You might be delinquent, but you wouldn't be in default. And at this point, you have to think about what's the downside of having a delinquency included in your credit report versus the benefit of waiving that in-school deferment and getting closer to public service loan forgiveness. And this is only if the servicer allowed you to move forward with retroactively removing that in-school deferment status. So for this borrower, I would really like them to take a look at the timing. Of course, how long the deferment was, when it was, but also what difference will this make when it comes to you making your case for public service loan forgiveness? Is it worth the potentially short-term credit issue of having a delinquency reported to credit bureaus versus the permanence of debt discharge happening sooner? If you're very close to public service loan forgiveness and waiving that in-school deferment would put you over the 120 qualifying payments you need to get loan forgiveness for PSLF, then you might want to pursue this because ultimately the debt is going to be discharged anyway. So what difference will it make to be delinquent for a few months? But if you are right now shopping for a car loan or you are trying to buy a house and your credit is going to be checked, you might want to think about what that delinquency could do. If the servicer allows to move it forward, what that delinquency might do to your credit. And that's if you are pursuing some other type of lending arrangements. So very loaded question. Remember, this is not a very common thing to retroactively have an in-school deferment status waived, but it is possible. You just have to decide, is it worth the risk of moving forward with that delinquency on your record? And even though you know that the debt is going to be discharged once you reach the 120th qualifying payment and submit your last PSLF application anyway, okay? All right, so we've got another PSLF question. This question is related to processing. And this is from somebody that I helped apply for PSLF, and they reached back out to me after our meeting and said the following. You said to send the completed PSLF application to MOHELA. My employer signed the form electronically, and I received an email from the Department of Education that they would submit the form for me. And if I send it in myself, that might cause a delay. What should I do? I want to say this loud for everyone to hear. Please listen to the Department of Education, okay? Up until this point, borrowers had to submit their signed PSLF application to MOHELA themselves. That was either by traditional mail, fax, or for people who have MOHELA as their servicer, you can log in, go to their document upload portal and upload your form. But the onus was on you, the borrower, to make sure that that signed application made its way to MOHELA. But as of just yesterday, a borrower that I met with, we completed the form online using the PSLF help tool. They were able to get their employer to verify that form the same day. And then they received this message that you're seeing on the right of the screen. Good news, your employer has completed their electronic signature as part of your PSLF and TEPSLF certification and application. Because you submitted your form electronically, we will take care of forwarding it for processing. Currently, no further action is required on your part. Furthermore, in bold, it is very important you do not mail your PSLF form in. If you do it, it could potentially delay processing. We do recommend saving your PSLF form for your records. And within that message, there is a link so that you can download the PDF of your PSLF application. So this was definitely news to me. I must say I am glad to hear it because sometimes people will send a form by traditional mail and they don't know whether it arrived. Sometimes they pay for for delivery confirmation and add on all these extra features to make sure that it got there, but they're still wondering, did it get there to the person that needs to get it to process it? Same thing with the fax. At one point, traffic was so high with the fax machine that people were getting no answer or inconclusive in response to sending a fax to MOHELA. So now we know the Department of Education will send these forms to MOHELA for you, at least if you use the electronic signature version of the application. So if you get this message, please do what the Department of Education says. I just recently became aware of this update. So I will be telling people from now on, if you use the electronic signature feature, then the Department of Education will take care of submitting this PSLF application for you. So that's another benefit of using the electronic signature version of the PSLF application. And I also wanted to share with you another update on processing because it appears that things are moving faster. So earlier this month, specifically on May 4th and the 5th, I taught a class about utilizing student loan coaching to help clients relieve their financial burdens. And that was a course offered through the University of Maryland, Baltimore School of Social Work. The class was on May 4th and May the 5th. And we found during that class that some of the people who were registered were public servants. So I connected with one of those attendees shortly after the class. So after she finished the class, she went ahead and submitted PSLF applications for 2 employers. That was May 8th and May 9th that she submitted those PSLF applications. By May 15th, her qualifying payment count had been updated to 90 qualifying payments. She still had one more employer to provide documentation for, so she did that on May the 15th. And by May the 17th, she had a qualifying payment count of 123. So a negative 3 months to go toward meeting that goal of 120 qualifying payments. So right now, we are waiting for her to receive notification of her discharge. I want to be completely honest here and say I have never, ever seen the process work this fast for anyone. So that says a lot. It lets us know that the electronic signature option definitely helped this person speed up the pace of the submission of their application as well as the evaluation of that application. We'll see how long the discharge takes. Typically, I hear that takes between 2 to 5 weeks, but for some people, it can be closer to 90 days. The standard answer that most people get from MOHELA is that it could take up to 90 business days. So I will report back on this borrower's outcome because it is the fastest I've seen in terms of getting a qualifying payment count. And I would like to see if the discharge follows along in similar fashion. So woohoo, congratulations to this person on reaching 123. All right, we've got another question about PSLF payment counts. This one is, I have a loan with 115 payments and one loan with 110 payments. What happens when you consolidate with varying payments? So the payment count issue, it can definitely get tricky, especially when consolidation is involved. So I want to first break down the difference between eligible payments and qualifying payments, and then we'll talk about consolidation. So if you've ever received a qualifying payment count or a payment count at all from MOHELA, you'll know that there are 2 types of payments that are tracked. There are eligible payments and qualifying payments. And I should correct that to say that there are 3 because there are also ineligible payment periods. But I just want to focus on the eligible and the qualifying because they are linked. An eligible payment is a payment period that can become a qualifying payment once employment is verified. So if you have a payment count and your eligible payment count is really, really high, your qualifying payment count is low, it could be because all of your employment has not been verified yet. Or if you haven't worked in public service for a long time, that would explain a large gap between your qualifying payments and your eligible payments. So as for a qualifying payment is an eligible payment for which employment has been verified. And these are the payments that matter when it comes to counting up how close you are to the 120 payments necessary to achieve PSLF. So before a person consolidates, I would take a look at the month-by-month breakdown within MOHELA's online portal to see if all of their employment has been verified, especially for a person who is so close to the 120. If their counts are currently 115 and 110, I would look at the date of the last PSLF application that they submitted, because that date would be the end of the periods that have had their employment verified. So if this person filled out a form 12 months ago, well, once they fill out a form today, loan 1 would go to 125, loan 2 would go to 120, and there would be no need to consolidate. But if this person just got their employment recently updated and it's up to date in terms of recognizing all of their employment, then they still have some time to go. 5 months on the first loan, 10 months on the second loan, but consolidation could speed up the pace. Let's take a look at how consolidation worked before the PSLF limited waiver and the IDR adjustment, because this gets to the heart of why some people are scared to consolidate. So prior to the waiver and the IDR adjustment, if you consolidated federal student loans, your old loans would be paid off, a new loan would be originated, and the repayment history of those older individual loans would not be recognized at all in terms of counting progress toward IDR cancellation, as well as public service loan forgiveness. So in this example, we have this person who has one loan with 115 months, another loan with 110 months. If you put them together before the waiver and before the IDR adjustment, that new direct consolidation loan would have 0 months of credit. So if this person is interested in PSLF, what it would mean is they have another 10 years to work. And also during that time of work, they need to make sure they're making qualifying payments. So this is looking forward another 10 years after already being in repayment for at least 115 months. For that reason, a lot of people said, you know what? I don't want to consolidate because I don't want to start over again. So when you consolidate under those rules before the waiver and the IDR adjustment, prior payments could not count toward IDR or PSLF. Everything had to be forward-looking. And that was a major turnoff for people who were thinking about consolidating. But now let's take a look at how consolidation works during the limited waiver, which that ended October 31st, but the IDR adjustment, which includes many of the provisions that were a part of the limited waiver. So the process of consolidating is the same. You fill out the application at studentaid.gov, your older loans are paid off, a new loan is originated for the exact same amount. The repayment clock resets to 0, but it's temporary. But I have to tell you, if you're on this PSLF journey and you consolidate, you will see the repayment clock resets to 0 when you get your first payment count, if the process continues to work as it has been. The repayment clock temporarily resets to 0, and after that, another count is performed that acknowledges the repayment history of those older loans that went into the consolidation loan. So for this person, after consolidation, they would likely get a letter from the servicer that says you're not eligible for PSLF because you don't have enough history. The payment count might be 2 or 3 because they're looking at the history of that consolidation loan first. Then typically within a few weeks, another count comes, and that count considers the repayment history of the older loans that went into the consolidation loan. So for this person, eventually the count would get to 115 for both loans. The reason being, when you consolidate during this IDR adjustment, the rules of the waiver apply to the consolidation loan. And the rules of the waiver said if these loans have overlapping repayment history, the consolidated loan is going to be credited for the amount of, for the number of months attached to the oldest loan, or the loan that has the most repayment history in the portfolio. So if you have one with 115 and you have another with 110, and you put that together, all of it now is 115. Now in this example, it's not that big of a gap. You have 115, 110. But for some people who have multiple degrees and took a break in between those degrees and worked in public service, you might find things like one loan has 115 months, another loan has 30 months. Case is still the same. When you put those two loans together, 115 will be the amount of months that's credited to the direct consolidation loan. And that means that all the loans are now on the same repayment clock, and the more recent loan has been sped up in terms of when it will be forgiven. So Credits earned through the income-driven repayment adjustment can be applied to PSLF. As for IDR, we expect the payment counts will come in 2024. With PSLF, you will get a payment count after you submit an application that documents your employment. Now, to get the greatest benefit out of the IDR adjustment, this person would need to consolidate by December 31st of this year. I have a quick note at the bottom of the screen that says these are two direct loans. Since they are already direct, when you combine them through a consolidation, they're still going to be direct because they're becoming a direct consolidation loan. So they would have been direct before, direct after. Consolidating direct loans does not affect a person's eligibility for the Biden-Harris Student Debt Relief Plan. That plan will provide up to $20,000 of cancellation for eligible borrowers. The Supreme Court is expected to announce its decision on the Biden-Harris plan next month. But with direct loans, you don't have to worry about jeopardizing eligibility for the Biden-Harris plan. If you have commercially held loans and direct loans and you put those together, then consolidation could present an issue because that consolidation loan might not be eligible for the Biden-Harris relief plan. I say might, the Supreme Court's making its decision next month, and we'll see how it turns out. The rules that were in effect when the plan got blocked, maybe they could change. That's why I think it's safest for people who have a mix of commercially held loans and direct loans to hold off on consolidation until the Supreme Court announces their decision. And we know what's going to happen with that relief plan. All right, so we've got another question here, which is, I have one FFEL Parent PLUS Loan. Should I consolidate? So can you consolidate just one loan? The answer is yes. You can consolidate one non-direct loan into a direct consolidation loan. So if they have a FFEL Parent PLUS Loan, it's just one loan, so there's nothing to combine it with. But you can consolidate it so that it transitions out of the FFEL program and into the direct loan program. And that opens up more doors in terms of relief. But if you're thinking about consolidating a loan, I really think that you should take into consideration how it will affect your repayment options and how it could affect your eligibility for relief. So I want to walk through both of those categories. The first is repayment options. With a Parent PLUS loan, Parent PLUS loans only have access to one of the income-driven repayment plans. There are several of those plans. There's income-based repayment, income contingent repayment, pay-as-you-earn, revised pay-as-you-earn. And if you take a Parent PLUS loan and want to enroll in an income-driven plan, not all of those plans are available to you. It's only the income contingent repayment plan that's available for people who have consolidation loans that include Parent PLUS loans. Income contingent repayment is usually the repayment plan within that income-driven family that requires the largest payment each month. Usually it is. So if you are not paying on an income-driven repayment plan now, and your plan is to consolidate this FFEL loan and enroll in an income-driven repayment plan, just keep in mind that only one option is available to you as a Parent PLUS loan borrower, and that is income contingent repayment. As for the relief options, let's go through those one by one. The Biden-Harris plan, the IDR adjustment, and then PSLF. So for the Biden-Harris plan, this is the plan that would give up to $20,000 worth of cancellation per eligible borrower. Consolidating the loan shouldn't impact eligibility, but it depends on the types of loans you have. If you have commercially held loans, they're currently ineligible for the Biden-Harris relief plan. So consolidating them will turn it into a direct loan, but you're not going to lose any eligibility. If the Supreme Court decides the plan can move forward and it's extended to allow people who had commercially held FFEL loans to consolidate into the direct loan program to gain eligibility, then that would help you because you'd be in the direct loan program. But if you have federally held loans are already eligible for the Biden-Harris plan. So if you consolidate them into the direct loan program, it will not change your eligibility. The loans are already eligible, and when they're in the direct loan program, direct loans are eligible as well. Now, for the IDR adjustment, if this FFEL loan is commercially held, it would not be eligible for the IDR adjustment because the IDR adjustment only gives payment counts to borrowers who have direct loans as well as federally held student loans, which leads me to the next point. If this is a federally held FFEL Parent PLUS Loan, then it's already eligible for the IDR adjustment. You wouldn't need to consolidate it to get it on track. When it comes to PSLF, it doesn't matter if the loan is commercially held or federally held. It has to be direct if you want it to be considered for public service loan forgiveness. So for this particular Parent PLUS Loan borrower, if you are working in public service and you want this loan to be forgiven by way of PSLF, then you have to consolidate it into the direct loan program so that you can get on track and get a payment count. If you're not in public service, then you have some things to think about. But whenever you're thinking about consolidation, at least right now in this period before we know what the Supreme Court's decision is going to be, just make sure that you're thinking about how consolidation could affect your relief options, as well as your level of comfort with the repayment options. Direct consolidation loans have income-driven options as well as balance-driven options. But if you're pursuing the IDR adjustment or you're pursuing PSLF, you want to make sure that going forward, you're enrolled in a qualifying repayment plan. Income-driven repayment plans qualify, but for parents, remember, there's only one that you're eligible for, and that is ICR. So use the loan simulator at studentaid.gov so that you can see what repayment would look like. If you would like a more accurate, perhaps, version, then I would encourage you to go to studentaid.gov and start the consolidation application. Within the application, it will ask you for your adjusted gross income, tax filing status, number of people in your household, and it will run the numbers for you to show you what ICR will look like, as well as what the balance-driven plans will look like. And if ICR is something that you're comfortable with, then you might want to move forward with completing that application. But there's no harm in starting it just to figure out what repayment would look like. All right, so about the IDR adjustment, I keep on talking about the IDR adjustment and things that people can do to get into the pipeline for it. So I want to explain why it's so important, but also start with a reminder that it only applies to borrowers with direct and federally held loans. If your loans are not direct and they're not federally held, then you would not be eligible to get a payment count through the IDR adjustment. But the IDR adjustment is really significant. It's because so many different categories of within the repayment status can be counted toward IDR forgiveness. And any time earned for IDR forgiveness can be applied to public service loan forgiveness as long as the borrower verifies their employment. So time toward IDR forgiveness includes, number one, any months in which you had time in a repayment status, regardless of the payments that were made, the loan type, or the repayment plan. So all of that history can count. The loan type piece just means that even if you had commercially held loans, that period could count. Of course, with that type of loan, you'd have to consolidate. But it doesn't matter if you actually made a payment or not. It doesn't matter if you had the wrong loan type or you weren't enrolled in an income-driven repayment plan. You could earn that time toward IDR forgiveness. Second, lengthy forbearances. If you have a forbearance that's 12 or more consecutive months or 36 or more months of cumulative forbearance over the life of the loan, all of that time can count toward forgiveness through income-driven repayment and public service loan forgiveness. Third, any months spent in deferment prior to 2013 outside of in-school deferments can count toward both IDR and public service loan forgiveness. And lastly, any time in repayment prior to consolidation on consolidated loans. So for the people who are thinking about consolidating but might be afraid that their repayment history is going to get lost, this should dispel that myth. If you consolidate during this adjustment period, the way to get the greatest benefit is to consolidate by December 31st of 2023. Any time in repayment prior to consolidation on a consolidated loan will be considered. As for when the payment counts will come, we expect to see them in 2024, but that's only for people who have direct loans and federally held loans. The good thing about a payment count is that it will give you an update to let you know where the threshold is that you're reaching for, whether it's 20 or 25 years. It will also let you know your progress toward meeting that requirement. And again, we should see those counts coming up for direct loan borrowers and borrowers with federally held loans in 2024. All right, next question is, how do I apply for loan forgiveness? And there is a lot to that question because loan forgiveness can come in many ways. I've spent a lot of time in recent months talking about the 3 major relief plans. So I just wanted to show you how to apply for each of those plans. For the Biden-Harris Student Debt Relief Plan, the application was online, but it's not available. We're waiting for the Supreme Court to make their decision. And if they allow the plan to move forward, then the online application will be restored. That application originally was supposed to remain available until December 31st of 2023. I don't know if that would still be the cutoff date if the plan is allowed to move forward, but we'll just have to wait until the Supreme Court issues its ruling. As for when you'll hear something, if you applied prior to the plan being blocked, you should have received an email about the status of your application. The original projection was that upon approval, it could take up to 6 weeks for the cancellation to be implemented, but no one received that cancellation because the plan was blocked before the cancellation was able to be issued. So if you already completed an application, just hang in there. We'll see what the Supreme Court says. If you have not completed an application, keep a lookout for what the Supreme Court says. And if that application becomes available, I encourage you to fill it out quickly. Next is the IDR adjustment. Now, the stakes might be higher for many people because a lot of people owe more than $20,000, and $20,000 is the maximum amount of benefit a person could get from the Biden-Harris Student Debt Relief Plan. So for the IDR adjustment, how to apply for it, there is no application. Everyone who has direct loans or federally held loans will receive a payment count in 2024. If you do have commercially held loans, in order to get them in the pipeline for the IDR adjustment, they would have to be consolidated into the direct loan program by December 31st of 2023. So there is no formal application. You just need to have direct loans or federally held loans. And if you have commercially held loans, you would need to, again, apply to consolidate by December 31st. As for when you hear something, we expect that it will be in 2024. And when more detailed information comes out about that time frame, you know that I will most certainly share that with you. All right, let's move on to the last program, public service loan forgiveness. With public service loan forgiveness, up to the entire remaining balance is at stake. And the way that you apply is by visiting studentaid.gov/PSLF, and you want to log into what's called the PSLF help tool to complete the PSLF application. One common misconception about the application is that it's difficult. And the truth is, it's not. It's an employment verification. That's all it is. All you need to have for each employer that you work for after October 1st of 2007, while you have loans in repayment, are 1, the employer ID number. You can find this on your W-2s, or sometimes you might find it on your pay stub, but you need the employer ID number for the organization that pays you. Also, you need to have a record of your starting employment date and your ending employment date, the average number of hours you work per week, and for right now, whether you are a full-time or part-time employee. That's all the information that you have to have. If you have that, you can complete the PSLF application, and after you complete your part, your employer will have to verify that what you've said about your work for the organization is true. Once they've verified, the form goes to MOHELA, which is the Department of Education's PSLF servicer. They evaluate it and give you a qualifying payment count. So if you're interested in applying for PSLF, visit studentaid.gov/PSLF, log in and get that application started. As for when you'll hear something about the status of that application, it depends on whether your employment qualifies. If your employment does not qualify, then you won't receive a payment count. But if your employment does qualify, you can expect to receive a qualifying payment count within 3 to 4 months of your application. Now, that's the way that things typically work in the years that I've been helping people with PSLF. But just this past month, I have to say things have picked up. They've started to move faster. I'm sure that has a lot to do with the electronic signature option that's been added to the PSLF application. And with the example that I gave you just earlier, we had someone submit the form on May 8th and May 9th, and they had an updated payment count by May 15th. So it's possible that it could move faster, but I just want to prepare you for the possibility of it taking longer than that. And what I've seen prior to this month is about 3 to 4 months before a person was issued an accurate qualifying payment count. All right, so let's move on to the next question. That's about borrower defense to repayment. The question is, I got a letter that says I'm still responsible for repaying one of the loans, even though I have a borrower defense claim within Sweet versus Cardona. What does this mean? So this person is someone that I've worked with, so I can give you some more details about this. This is the person who filed a borrower defense to repayment claim well before the class action lawsuit listed here, Sweet versus Cardona. For a lot of people who filed borrower defense claims many years ago, those claims sat still within the Department of Education. There was no evaluation taking place and their loans were in forbearance the entire time. Enter this class action lawsuit. Finally got resolved initially last year, but it was appealed several times, and finally the relief has been allowed to move forward. The Supreme Court was involved in this decision as well. So for this person, they had an outstanding claim for years and years, and they received some information from their servicer that was a bit confusing. Some of the loans were listed as discharged, one loan was left remaining. But from our view and understanding, all of the loans were supposed to be canceled because they were a part of that class action lawsuit. So my initial response to this person was, let's go online, let's check your claim status through studentaid.gov. There's a borrower defense claim center, but when we looked there, the claim did not show up. And I believe what we saw was the reason was that if the claim was filed prior to 2018, it does not show up in the online portal. So we couldn't get an update there. So we went to the phone, contacted the borrower defense hotline, spoke with a customer service representative, and they just had limited information. They offered to assign a caseworker who would respond, I think, in 3 to 5 business days, something to that effect. While we were on that call, I asked about contacting the servicer. So we were transferred to the loan servicer, and the loan servicer was able to tell this person that their loans were discharged 6 days before we made the phone call, but the letter was in the mail and had not arrived to the borrower yet. So the online portal was not particularly helpful for this person because of the time frame during which they filed their borrower defense claim. The borrower defense hotline did not provide the detail that we were looking for, but when we reached out to the servicer, we received so many details and confirmation that the debt had been discharged. And since this debt has been discharged, the borrower has started to receive checks. Prior to the discharge, the borrower had already received one check, but the check came before the notification of the discharge. So it just created a lot of confusion and disbelief. You know, the person was wondering, is this the start of it? Is this real? Because I just got a check, but I also got this letter that says I'm still responsible for this loan. So why am I getting a check if I'm still responsible for this loan? So what ended up happening was their claim was approved, and now they're in the process of getting refunds for the amount that they had paid toward that debt. If you filed a claim that was included as a part of Sweet versus Cardona, that class action lawsuit, I would encourage you to check on the online portal anyway, but truly reach out to your loan servicer, because the level of detail that this servicer provided just answered all of the questions that this borrower had and let us know that the claim was moving forward and that the loan discharge had been processed. If you have questions about borrower defense, you can visit studentaid.gov, and on their announcements and events page, there's a borrower defense update section. Well, it's actually an entire page for borrower defense updates, and you can find out what's been happening with these borrower defense claims related to different schools. So another success story there, about $145,000 canceled for this borrower by way of borrower defense to repayment. All right, so that wraps up the questions that were submitted for this evening's edition of Office Hours. As always, before I close out, I want to share with you options for accountability. The first one is the Consumer Financial Protection Bureau, and you can visit them online at consumerfinance.gov. You can file complaints related to lenders, your servicers, and from my experience with the CFPB, you get results. Also, the U.S. Department of Education has an ombudsman. The ombudsman has very specific criteria for issues that their office will deal with. And also there's the option, if you're pursuing public service loan forgiveness and your payment count just does not seem accurate at all, you can submit a PSLF Reconsideration Request. I just want to say that if you just consolidated and received your first payment count and it's really low, I don't think you need to go through with filing a PSLF Reconsideration Request, because after loans are consolidated, the first payment count only considers the history of the consolidation loan. Several weeks later, another count comes that usually reflects the rest of the repayment history. So you might want to save yourself the trouble of filing a reconsideration request and just wait a few weeks to see if your payment count is updated. You can also check online at MOHELA.com, take a look at the PSLF menu and the payment tracker, because you can see month by month where your employment has been verified and where verification is still necessary. As for the state of Maryland, we have a student loan ombudsman who is dedicated to helping borrowers with student loan servicing problems. The types of problems handled by the ombudsman's office includes, number one, failure by the servicer to communicate with the borrower. 2, errors in crediting principal and interest payments. 3, misapplied payments. 4, inaccurate interest rate calculations. 5, billing errors. 6, loan consolidation and modification errors. And 7th and finally, inappropriate collection activities or tactics. Also, you can file a complaint with the ombudsman online by visiting the state's Department of Labor, and you can take a look at the Maryland Student Loan Borrower's Bill of Rights, and that way you can find out as a Marylander the protections to which you are entitled and the obligations that your student loan servicers have. And again, the ombudsman is located within the state's Department of Labor. You can visit them online at dllr.state.md.us. All right. Thank you so much for joining me for this evening's edition of Office Hours. It is May the 24th, and I'm looking forward to getting back for another edition in June. I'm not going to hop off just yet because I see that we have something in the Q&A, and I want to make sure that I answer that. The question is, will there be a recording available of the meeting? Absolutely. A recording will be made available, and we actually, you don't have to wait for the recording because we're on Facebook Live. So you can go on Facebook and visit the Maryland Center for Collegiate Financial Wellness, and you'll be able to review this video pretty quickly. But in a couple of days, usually we upload these videos to YouTube and annotate them so that we can allow people to visit the recording after the fact and go straight to the content that's about the question that they wanted to have answered. So yes, that's a long way to say the recording will be made available. Let's check and see if there's anything else. All right. No open questions at the moment. I do want to backtrack a bit because for the question that was submitted from that participant, I actually answered the question that you submitted earlier. So I'm going to back up in the slides so that we can go to that question. So pardon me while I rewind, but I just recognized your name. Okay, so this was about the in-school deferment and the possibility of retroactively waiving that status. So as you know, because you've applied for this, periods of in-school deferment don't count toward forgiveness by way of IDR or by PSLF, but servicers can retroactively change a loan's repayment status. Now, I've seen mixed information about this. I've heard that some servicers will not allow you to change the status of a loan if it will result in a delinquency or default. I've heard other people say that the servicer said, yes, they would do it. However, it could put the loan into a state of delinquency or default, and those consequences would be passed on to the borrower. So I'm not sure. That's why I said might, because sometimes they present it as a possibility that they can do it, but with the disclaimer that if they do it, there will be consequences that are then reported to credit bureaus. And then I've also heard that some say if doing this, retroactively waiving that in-school deferment would put the loan into delinquency or default, then they will not do it. So you'd have to provide proof that you made payments to prevent that loan from going into a retroactive delinquency or default. So as for the questions to consider, the first thing I wanted to point to was the timing of the deferment. If the deferment was during the CARES Act forbearance that went into effect March 13th of 2020, then technically delinquency would not matter because no payments were required during the forbearance. So for these past 3+ years, we haven't been required to make a payment. So if you didn't make payments during that time, then you would not have been considered delinquent, and those periods could be included as credit for public service loan forgiveness if they were to retroactively change the status of that loan from an in-school deferment to being in repayment. Also, if that deferment was more than 7 years ago, technically the reporting on that piece should be done. But this is where the servicer comes into play, because I don't know if this servicer is one of the ones who will not allow the retroactive change because it would send the loan into delinquency or deferment, or one that would say, you know what, we'll let you do it and deal with the consequences. Also, how long was the deferment? To become delinquent with student loans, all it takes is for you to miss a payment. So delinquency can happen pretty quickly, but default happens after you've missed payments for up to 270 days. So my thought process here was that if your deferment was quick, if it was 1 semester, that would not put you into default because a semester is less than 9 months. But if your deferment was for 2 years, then if you wanted to retroactively remove that in-school deferment status, that could put you into default if you were not making payments during that time. And the last consideration, again, was how close are you to PSLF? From the servicer's perspective, if they allow you to have that status change and it results in the loan being retroactively delinquent or in default, then that could cause a credit issue for you because that delinquency or default could be reported to the credit bureaus, and that could cause your credit score to go down. If you are, pursuing a mortgage or a car loan, then it could make the terms less attractive, or you might not be able to find a lender. On the other hand, you have the long-term possibility of permanent discharge because the debt will eventually be forgiven by way of PSLF. So if this retroactive change would put you over 120, you might say, you know what, it's worth the risk for me. But if it's something that's not going to bring you that much closer or isn't going to result in a quick discharge, then you might say, you know what, I'm not sure if I want to do that. But ultimately, the servicer is going to let you know what will happen and whether they will do it. If you did make payments during those periods, I am all for, doing whatever you can do to get that PSLF qualifying payment count up to 120. But if you are not making payments and the period was not during the CARES Act forbearance, that's when you got some exposure to risk here, okay? All right. All right, we've got a follow-up. Thank you for these details. It was 2016 to 2019. The loan is with MOHELA, and I found 3 payments made during that time in 2017 and 2019. I submitted the payments today. I think they'll only count those 3 months. We'll see. Thank you so much for sharing exactly what's going on, because this is what helps us provide more realistic and actionable information for people when we know what they're dealing with and when they reach out to their servicer. So 3 months are at stake, but I know every month counts when you're trying to reach that goal of 120. So please do keep me posted on how that works out for you. I know that that's not something that a lot of people can do, but if it's an option that you have and it could help get you closer to 120 without a lot of risk exposure or detriment on your side, then I say go for it, and I'm rooting for you, okay? All right, I am going to scroll back to my thank you screen really quickly. I scrolled too much, so I'll go ahead and stop sharing at this point in time. Again, thank you so much for joining me for this, the May 24th edition of Office Hours. My name is Dr. Tisa Silver Kennedy. I'm the founder and director of the Maryland Center for Collegiate Financial Wellness. We have other events coming soon, two other editions of office hours next month. I believe they're scheduled for June 14th and June the 28th. We also have our third annual virtual symposium, which is advancing collegiate financial wellness as an essential ingredient for student success, coming up on July 25th from 9 to noon. If you are interested in any of our events and our programs, please do visit us online at mccfw.org. And of course, we are on social media at the MCCFW. If there are no other questions, I'm going to check the Q&A as well as comments on Facebook. All right, looks like there are no other questions. I thank you again so much for joining me. And until next time, be well.